Hello, everyone, and welcome to this week's podcast from March the 14th. We're actually recording this on the 13th, but this will be coming out on the 14th. My name is David Clark, and I'm actually joined by my brother from another mother, Miles
How
Clark.
you doing, David?
We're hanging in there, man.
We're recording this on the morning, so this is pre-lunch. Now, if you've been with David and I on podcasts before, you know that we'll sometimes, when he's in town, go out to ZZQ, Easy Burger, whatever. We'll come in, probably consume about 12 to 1300 calories, and
Oh, at a
your week's
minimum, if
worth of
not
salt
more. I mean,
before. So we're actually super energized. It's early in the morning. Markets have not been energized over the last week, or maybe they have been energized in the wrong direction, right? In terms of the last week, what are we looking at?
well, over the last week, it's been mostly negative for U.S. equity indexes. Major leader to the downside is the Nasdaq Composite, Nasdaq 100. Nasdaq 100 down over 5% over this 1 week roll.
That's got to be like that's pretty intense, right? 5% you kind of shed there.
Well, and in many cases, it's kind of interesting that, we always come up with these adages, especially sort of on our research side of, oh, the market does X so many times per year. And I mean, we know that 5% pullbacks can happen in a given year and likely multiple times in a given year. And typically you get one 10% pullback in a year, but even then that doesn't necessarily entirely help how it feels when we're experiencing the 5%
And
drawdown.
it's so crazy that a lot of clients have been calling in. Of course, when there's market turmoil or there's market turnover or leadership changes going on, people will call. The phone lines are a little bit more busy around the office, everything like that. You see it time and time and time again. You've been in the industry longer than I have, but even in my, limited experience in the last, half decade or so, we preach emotionless investing, right? Systematic, rules-based stuff. People are familiar with, hey, we just need to let the market do its thing. Pullbacks are normal, exhales are normal. But dang, if everyone doesn't feel different, right? Like, how do
Mhm.
you get through, again, using your kind of experience from, the time that you've been in the industry? How many pullbacks have you seen? I'm not calling you old here, don't get me
No,
wrong, but
yeah.
like, how do you actually put your money where your mouth is if you're a client that's dealing with investor assets and they're worried? How do you manage that, do you think?
Well, I mean, in many cases, it's a super simplistic quote, but you mentioned sort of put your money where your mouth is. One of the things that I always remember from my early days of Dorsey, Wright, is there was the Mike Tyson quote of, everybody's got a plan until you get punched in the mouth
Hmm.
type situation. And that's part of it is, you know, whether, we're believers in our process, but whenever markets begin to decline and you begin to get through those things, having a process in place to help you at least maybe get a little bit defensive. We're not saying you got to sell the farm type situation to get defensive, but having a process in place to get defensive or look elsewhere in other classes, asset classes, that's what you're looking for. And at least being prepared to have other options. And I mean, does that always quell fears? No,
Right.
but I mean, it's gonna mitigate them. Yeah,
Yeah.
and that's the idea, right? You're doing your best over time, and in these types of environments, or honestly, even further negative environments, are where somebody with a process already in place is going to be, pulling potentially new clients in because that's a process that can be driven from client to client, but also that's something that can go through word of mouth. That whenever
Right.
the market went down, such and such was able to have this process that got us defensive, and we were able to weather the storm. So I
Right.
mean, a lot of that is rambling to say whether it's us or somebody else. As long as there's a process driven way to get defensive, realize when we're beginning to, see the market turn again, and then when we can step back in and what asset classes and things we should be looking at, that's where you just sort of have to make your bed and rely on it. And I mean, it's a little bit of like a religion. You got to have faith, right?
Right.
That this is what I believe in, and this is how it's going to work out, or at least historically, this feels how it's worked out or behaved in these environments. So you sort of have to find your bed and make it
Right.
type
Well,
situation,
no, it's good.
but
It's good
stay
color.
there.
Yeah, no, it's good color. And I'll say this because, again, when you do have what looks to be, again, and don't quote me on this, right? 5 months from now, when growth is still in favor and tech has come roaring back, but you have the beginnings of what we would call a kind of sector or leadership rotation, right? And so momentum, elephant in the room, momentum has struggled a little bit off of its highs, right? We've seen the dispersion between leaders and laggards kind of fall a little bit. And so, again, and when there is that change in momentum, things can be a little bit, or change in leadership, things can be a little bit painful, right? So remembering, to your point, have faith in the process, your process, whatever it is, and kind of go from there. We believe, again, time in the process or time in the strategy is more important than timing the strategy. So, that part of that human emotion that's in play is you often see underperformance, or you look at a poor month or something like that. That's actually the worst time to leave, because especially in momentum, it's a self-correcting, and I want to emphasize this, self-correcting strategy what am I looking for? Factor, excuse me, self-correcting factor, where it will rotate back towards what's strong once price tells us. So there was a lot there that I just said, maybe only a little bit made sense. But that's kind of what I kind of anticipate when you put these pullbacks into perspective.
Yeah, and I mean, as you even sort of alluded to earlier, each one's different.
Yeah.
So I mean, there's no way of defining how this one behaves from here.
Right.
But the catalyst for a lot of it, we're still just seeing a lot of uncertainty about. And I mean,
Yeah.
take your pick at this point.
Right.
I mean, we got a cooler than expected inflation print yesterday, and led to a little bit of a rebound. But I mean, kind of underwhelming,
right,
in a way. At least what most people would associate with those sort of better than expected inflation prints. We've gotten a lot of reaction on those, but it seems that, again, take your pick among the many things. There's just a lot more weighing on the market than talking about just inflation.
Well, and you look at it and you say, well, what is the market not like? It doesn't like uncertainty, right? So it likes predictability, kind of understanding what's coming, and really only focusing for the past year and a half or so on the inflation number. That was really every month, like clockwork, that was the thing that was essentially going to determine what the market looked like for the next 30 days. What's the Fed
going to do afterwards?
Right. Now you've got geopolitical concerns, trade wars, everything like that. There is a bunch more uncertainty, which has led to relatively high VIX levels, right? So, VIX levels are pretty elevated around current levels. That's kind of the fear gauge, or maybe we can put it like this, an uncertainty gauge. So the higher that level is, the more uncertainty is present, is present in the markets. And, that's been the case over the last couple of weeks, and really last week as well, as you've seen that spike up over, where is it now? Is it going off a little bit? Is it 26, 27?
Stay here for the old VIX.
Come on, you're on the clock, man.
Yeah. Currently 24.
Okay, so we did get a little bit of a back off yesterday with
got as high as 29, which was the highest that we've seen since, looks like, when we got the unwinding of the yen carry trade back last year.
Well, point is, I mean, there's a lot of uncertainty, and again, you kind of say, okay, well, where is growth focused? Where is leadership focused? Is it in growth names? Is it in value names? And we're seeing, again, the beginning of some relative strength changes. Now, we could talk about major indices. One that I want to mention is that VUG versus VTV relative strength chart. So for the uninitiated here, Dorsey, Wright, hopefully you know this, but maybe you don't, but we're a relative strength shop, right? So we compare one asset versus the next, and that's kind of the bread and butter. And so we are going to throw up on screen now a 3.25 scale RS chart between a growth representative VUG and a value representative VTV. So again, this is just an arm wrestling contest between the two, if you don't get kind of the lingo behind it. But we did see this reverse back down in favor of value this week. Said otherwise, we've seen about 10% outperformance of value versus growth over the, in the recent past, leading into that reversal. Is that significant to you, or is that just the first step?
I mean, in a lot of cases, it's sort of the first step, and I wouldn't say the first step. It's a first step, rather, among many that we're sort of looking at, because, as we always talk about, it's building the weight of the evidence one direction or another, right? And even looking elsewhere, like we've seen some sort of dolly changes over the past week or so, with communication services moving up to 1, utilities climbing. So sort of that more defensive thought. Well, communication services is kind of an interesting situation because where that relative gain has happened for that sector, at least very near term, has been within those more traditional telecoms names.
Right.
And where we're seeing utilities pick up is more not so much the focus on all the companies that we're going to be working with the AI partners and supplying power for data centers, but the more traditional utility companies. You've seen
Right.
a lot of gas utility companies sort of sustain pretty well, and as well as others. Point being, you're sort of seeing that follow through from VUG, VTB, favoring value somewhat on the sector level and beginning on the sector level. Now, there's still there's still an offensive tilt
Mhm.
to Dolly in general.
Right.
But I mean, we've seen the bogey check reverse down now for domestic equities. And
Bogey
again,
check is a short-term indicator of the broad asset classes strength. So domestic equities as a whole, we're not talking value versus growth at this point, but domestic equities versus cash is our bogey check. So again, we've seen a near-term pullback for domestic equities. The bogey check is a very sensitive indicator. So there's a lot of head fakes in there, but typically it's the first thing that kind of flips, if you will.
well, and as we're sort of talking about here, that the combination of the bogey check, we're seeing value pick up in strength, we're seeing value related areas pick up in strength. And the reason for that is, even if you're watching stocks fall or you're watching something, two things fall, one can fall at a faster rate. And as far as relative strength is concerned, that's positive RS somewhere, right?
Right.
So that's why even when we're looking at some of these names, they may still be down a little bit, but they're not down as much as others. And that's one thing to also keep in mind just with relative strength is, I mean, it's going to in essence find a best in class situation,
Right. No matter
now
what the best in class is, right? I mean,
right, that's part of it. You could have a class full of just what's or whatever you
Right.
want to call it, but bad, and you're just picking among the bad.
Right.
I mean, and that's part of it is understanding what could be transpiring in terms of what we're seeing in terms of leadership changes, and we're beginning to see some of those dominoes fall.
Right.
Now, have we seen it, I would say, get to the point that we're really saying get defensive? No.
Right. I mean, domestic equity is still well ahead of the rest of the groups. You take a look, international has done very well, right? Europe particularly is kind of improved. Other areas, China, Latin America, even as a relative laggard. We talked about this on previous podcasts, but kind of the anti-Trump trade, those have actually all done pretty well since November. So very interesting. That's going to definitely be something to watch. But in terms of the longer term strength, domestic equities still in favor. But again, speaking to that, where does the domestic equity strength lie? And you talk about participation or, with kind of furthering that conversation of the average stock versus the cap weighted stock. You look at the Magnificent Seven, most of them are well off of their highs. Meta is actually, I think, the only one that's positive on the year. I don't quote me on that, but most are negative. You see Nvidia, shedding 10-15% so far, Tesla as well. Meanwhile, the average stock, the S&P 500 equal weighted index, is just about flat for the year so far. So we haven't seen the average S&P 500 stock take it on the chin as hard as your big names. And again, that really is just another building block in our conversation for today. These growth focused areas, the leaders of the market throughout the last 2-year rally, they've kind of turned over a little bit. They've shown some weakness.
Yeah, and I think when you're referring to that and talking about participation, that's part of why we have seen our indicators move lower, but I wouldn't say they've sort of wholesalely moved abruptly lower.
Right. They have not
It's sort
washed
of
out.
been steady as you go,
Yeah.
working their way down. And as you alluded to, it's part of the average stock is doing one thing while your major large cap name or your major mega cap name, Magnificent Seven, whatever it may be, is down further.
Now, there's two sides to the argument there, and one is good and one is bad. One, for you bulls in the room, it's, hey, markets are down so far this year, but the average stock isn't isn't not participating. Let's put it that way, right? Like on average, things are still okay underneath the hood. So, is it real? Should the markets really be down 3%, 4% for the year so far? Maybe. Of course, if you're a little bit more bearish, you'd say, well, markets are already down 4%, and the average stock hasn't rolled over yet, right? There's still a lot of room left to wash out. And that brings up the conversation of oversold, right? Markets, a lot of conversation over the last week has been markets are oversold. This has been too fast, everything like that. Yesterday, Wednesday, the 12th, we got a bit of a bounce. But just to put it in perspective, markets can get a lot more oversold. Historically, we're nearing some relevant levels, but you can stay oversold for a little bit, right?
Yeah, and one of the indicators, we were talking about this on the video before, and I was looking at it yesterday and even this morning, that we follow for sort of that oversold, overbought condition is going to be the weekly distribution or weekly overbought, oversold, sort of interchangeable terms we use there. But the particular indicator we're referring to, or at least going to talk about here, is going to be the WD for NYSE. So caret WD NYSE on our site. And that'll pull up what, in essence, is the average weekly distribution reading or weekly overbought, oversold reading for stocks within the S&P or NYSE, not S&P 500, NYSE.
Right.
There's a few different ones. So there is one for the S&P 500, but we're talking about the one for the NYSE. Nonetheless, with yesterday's action, we saw that little bit of a bounce,
Yeah.
but we actually saw the average oversold reading further decrease down to match the low point that we saw in January of this year as well as December of last year. And part of what you were alluding to of yes, markets can continue to lower. This indicator can get to 40 minus 40% and below.
Right.
I mean, suggesting a further oversold condition. But really, that minus 40 line is often the demarcation when we're looking at sort of those oversold, washed out levels.
Where are we right now? Sorry.
So the WD for NYSE.
No, I know. Where are we?
And right now we're at minus 32% with
Okay,
a reading
yeah.
of minus 33.
Right.
So inching closer to that minus 40. But the last time we saw that minus 40 level was in late 2023.
Right in October or so after that pullback.
Yeah.
So here's where, and maybe we can end our conversation on kind of this idea, is that a lot of our indicators, a lot of our signals, particularly these participation indicators, they will typically say, and with participation specifically in kind of near-term washout levels, most of the time, I don't have an exact statistic behind it, excuse me, most of the time they reverse up and everything is fine. Of course, the caveat to that is the one where you do just continue to get more oversold. You look at levels 2008, 2020. Now that was very quick, but you got very oversold very quickly. Historically, going back into the the 80s and 90s, there are some levels in there as well. But point being, most of the time you get bounces. Some of the times you don't. Now, I'm not sitting here and saying we're due for another 10, 12% pullback from here. But, that is how you can kind of play these things. And that's why we would say, hey, just continue to exercise some caution, keep your eye on the charts because, more than likely this is just a 10% pullback in a bounce. Maybe it's not, right? And again, I'm not trying to spell doom and gloom, but that's the importance of staying diligent, staying unemotionless and keeping your eye on what price action is really telling you, because it will tell us what's actually happening. Do you have a final word maybe?
I mean, at this point, we've talked a lot about just looking at various things, and there's a lot been change. There's been a lot of changes. There's sort of these initial dominoes falling that, like you said, we're suggesting caution. It's not like you're making massive wholesale changes right now, but there's still a lot of caution abound because there's a lot of uncertainty abound. Until we start getting some of those answers, still going to exercise some caution.
Well, listen, Dave, it's always a pleasure to be with you. I appreciate you getting you across the table, and we'll be back again next week. Have a good one, everybody.